Hello, and welcome to this lecture on the 5 key functions of the Federal Reserve System. In this class, we will discuss the mandate of the Federal Reserve System. By law, the Fed exists to promote the effective operation of the US economy. We will see what this means in practice. We will see the 5 key functions of the Fed. These 5 key functions are to conduct monetary policy, promote financial system stability, to regulate and supervise financial institutions, to provide an efficient payment system, and finally to promote consumer protection and community development. We will discuss these functions one by one and see how they connect with the goals of the Fed. Let's get started. The Federal Reserve Act of 1913 created the Federal Reserve System. Under the Act, the Fed must conduct monetary policy to foster a productive and stable economy. Monetary policy has evolved over time. Nowadays, it involves controlling short-term interest rates. By law, the Fed must use monetary policy to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. These are the goals, but what do they mean? Maximum employment usually refers to a situation when most people who are looking for work are gainfully employed. Stable prices encourage savings and investment. By contrast, when inflation is high, asset returns can be lower. This reduces households' incentives to save and businesses' incentives to invest. Similarly, moderate long-term interest rates increase business incentives to invest. Under maximum employment, stable prices, and reasonable long-term interest rates, the belief is that there will be stable growth and a thriving economy. This is what the Fed hopes to achieve. The second key function is financial stability. What is financial stability? Generally, we consider a financial system to be stable when it provides services to households and businesses at reasonable cost and without interruption. The financial system consists of financial markets and financial institutions, such as banks. A stable system channels funds from savers to borrowers. This allows for an efficient allocation of capital across the economy. To fulfill this responsibility, the Federal Reserve monitors the financial system. In fact, it monitors using 2 approaches. The first is called the microprudential approach. This focuses on risks at specific institutions. This could be a bank or an insurance company. The microprudential approach is related to bank supervision. We will discuss this shortly. The second approach is macroprudential. This instead looks out for risks that could impact the entire financial system. The Federal Reserve monitors several measures of financial market stress. An example is the amount of borrowing or leverage in the financial system. Leverage can amplify losses and cause defaults. Another example is the amount of short-term borrowing by financial firms. Short-term borrowing can cause runs that disrupt the flow of credit to the economy. The third key function of the Federal Reserve is to regulate and supervise financial institutions. Regulation and supervision are distinct but complementary activities. Regulation relates to the writing of rules. These rules often place restrictions on financial institutions. This process starts with legislation in Congress. This gives the Federal Reserve the authority to draft rules. With input from the public, the rules are finalized and published. Financial institutions must then comply with the rules. The Truth in Lending Act is a good example. Under this rule, the Federal Reserve requires lenders to clearly disclose lending terms and costs to borrowers. This includes the interest rates on a credit card. Supervision, on the other hand, relates to the compliance with the regulation. For this purpose, the Federal Reserve employs and trains bank examiners. Examiners conduct visits to regulated financial institutions to ensure compliance with the rules. This involves in-depth inspections of the bank's operations. If rules are violated, supervisors can impose fines and other penalties, such as restrictions on dividend payments. Supervision relates to financial stability. It is a microprudential approach. Supervision ensures the safety and soundness of individual financial institutions. The fourth key function of the Federal Reserve is to provide an efficient payment system. Currently, the Federal Reserve supports a variety of payments. This can be currency. The Federal Reserve issues paper money or cash that traditionally was used for many household transactions. The Federal Reserve also facilitates check clearing. Automated Clearinghouse, or ACH, settles small value bank transfers like wage payments to employees or the payment of your utility bill, and also large value transactions or wholesale payments among businesses and banks. The fifth key function of the Federal Reserve is promoting consumer protection and community development. Improving access to affordable financial products provides financial stability for families. To this end, the Federal Reserve implements various consumer protection, fair lending, fair housing, and community reinvestment laws. We mentioned the Truth in Lending Act earlier. This is about transparency and fairness. The Community Reinvestment Act is another important example. Under this rule, the Federal Reserve collects data on how much credit flows to communities and encourages financial institutions to provide access to credit for the entire communities that they serve. This includes lending to low and moderate income neighborhoods. In this session, we have provided a big picture review of the purposes and functions of the Federal Reserve System. We discussed the 5 key functions of the Fed: conducting monetary policy, financial system stability, regulating and supervising financial institutions, providing an efficient payment systems, and finally, promoting consumer protection and community development. Taken together, these functions support the US economy and more generally serve the public interest.